Welcome back to The Explainer. Today, we're unpacking Weatherford International's Q2 2026 earnings report. And I promise you, this isn't just going to be a dry run through a corporate balance sheet. Hidden right within these numbers is a highly dynamic story about global energy, operational agility, and how a massive company actually steers the ship when the geopolitical waters suddenly get very, very choppy.
So, how exactly does a global energy services giant navigate sudden geopolitical conflict? That's the defining question for this quarter. When we look at the global energy sector, we're looking at companies whose operations are intimately intertwined with world events. This quarter gives us a real-time masterclass in corporate resilience and macroeconomics. I mean, how do you maintain cash flow, secure your future, and keep shareholders happy when a major operating region is completely disrupted by conflict?
Okay, let's dive into this. For Weatherford, Q2 2026 was defined by a very specific, undeniable challenge: significant disruptions in the Middle East stemming directly from the Iran conflict. This wasn't just some theoretical risk models were predicting, it was an on-the-ground reality that immediately impacted their activity levels. But as we dig into the core of Weatherford's results, the story isn't really just about the hit they took, it's about how their underlying operating paradigm absorbed that shock.
President and CEO Geir Sahlgren actually summed it up perfectly. He stated, despite the significant disruption in the Middle East due to the Iran conflict, our second quarter results, especially adjusted free cash flow, were strong, demonstrating the reliability and resilience of our operating paradigm. This quote is absolutely crucial because it impartially contextualizes the headline numbers we're looking at. It sets the stage for a quarter where top-line revenues definitely felt the squeeze of global events, but intense internal discipline held the line on stability.
And honestly, the numbers brilliantly illustrate exactly what we're talking about. Just look at this striking duality. Sequentially, Weatherford's net income took a sharp drop, decreasing 64% down to $39 million, heavily pressured by those geopolitical headwinds. Yet, at the exact same time, their adjusted free cash flow surged by a mirror image 64%, landing at $139 million. It's a remarkable divergence, right? The company was making less net profit on paper because of the immediate disruptions, but they were actually generating significantly more cash. It proves the underlying efficiency of their operations, even when under immense stress.
Section 1. Segment and regional performance.
To really understand how they pulled off that cash flow, we need to break open the hood a bit. Weatherford's revenue engine is largely driven by three core segments out of a total quarterly revenue of $1.105 billion. The biggest piece of the pie is Well Construction and Completions, or WCC, coming in at $433 million. Next up is Production and Intervention, PRI, at $316 million. And finally, Drilling and Evaluation, DRE, generating $291 million. Understanding these segments is key to seeing exactly where the Middle East disruptions hit them the hardest.
Now, as you might expect, the drilling and evaluation and well construction segments really took the brunt of the hit. DRE saw a sequential revenue decline of 9%, and WCC dropped by 2%. The earnings report directly ties these declines to lower activity in the Middle East, North Africa, and Asia regions. Whenever geopolitical tensions flare up, drilling and well construction are almost always the first activities to face delays or operational hurdles, and we see that clearly reflected in these numbers.
Now, what's really interesting here is this massive 30% jump. While the drilling and well construction segments were shrinking sequentially, the production and intervention segment, PRI, saw a massive 30% sequential growth in its adjusted EBITDA. That's essentially their core operational profit. This segment completely broke the negative trend of the quarter, stepping up to provide some much-needed financial padding.
So, what drove that remarkable 30% growth in PRI profit? Well, it came down to two major operational wins. First, they saw significantly higher international pressure pumping activity. And second, they capitalized on higher artificial lift activity right here in North America. These specific wins perfectly showcase the advantage of having a diversified global portfolio. When one regional product line stumbles, another can surge forward and pick up the slack.
We can see this regional balancing act clearly when we compare the geographies. The Middle East, North Africa, and Asia region saw sequential revenues drop by 6%, but contrast that with the Europe, Sub-Saharan Africa, and Russia sector, which actually grew by 10% sequentially. That growth was driven by higher pressure pumping and managed pressure drilling, or MPD activity. This proves that while the disruption was intense, it was heavily localized, and Weatherford's other international sectors were actively expanding.
Section 2. Tech and Operational Highlights. Let's step away from the pure financials for a second and look at the on-the-ground reality. Take a look at these high-value contract awards from Q2.
They secured multiple MPD contracts with Noble Corporation in Nigeria. Over in deepwater Brazil, they locked in MPD and intervention contracts with Constellation and Ventura. And incredibly, in Oman, Petroleum Development Oman awarded them a massive 3-year contract covering 247 wells. These aren't just small, token wins. They demonstrate the ongoing baseline strength of Weatherford's international operations and their technological edge despite the broader market volatility.
And they aren't just sticking to traditional oil and gas either. I actually found this part of the report particularly fascinating. Weatherford is actively deploying its advanced tech into the broader energy transition space. They delivered their first European operation using their specialized Mars extraction system for geothermal energy in Denmark. And over in France, they used their MPD light tech to support lithium exploration. It's wild to see a traditional oil services giant adapting its heavy machinery to chase battery materials. It shows an agile company adapting its core competencies to push the boundaries of new energy markets.
Section 3. Strategic M&A and Redomestication.
Let's move on and see how this builds a stronger foundation for tomorrow. Management announced 2 major structural plays for the future. First, the acquisition of NCS Multistage to expand their well completions portfolio. And second, an updated plan to redomesticate the company's corporate structure from Ireland over to Delaware.
Now, the acquisition of NCS Multistage isn't just a play for shiny new tech. It's a highly calculated financial maneuver. Weatherford's management expects this integration to bring a highly focused expectation of at least $15 million in cost synergies right out of the gate upon closing. It's a targeted move to strengthen a core segment while streamlining their overall costs.
And then there's the redomiciliation. Previously, Weatherford tried to move to Texas, but they actually fell short of the shareholder votes. So they pivoted to Delaware. Why go through all this corporate paperwork? Well, it's because of this number. Moving to Delaware is expected to save $20 to $30 million in cash every single year, starting in 2027. By simplifying their corporate structure, they're directly enhancing their long-term cash flow profile. It's a massive financial incentive.
Section 4. Outlook and shareholder value. Let's bring all these threads together to see what this means for investors. Even amidst all the headwinds and regional volatility, Weatherford maintained strict financial discipline regarding shareholder value. During the second quarter, they paid out $20 million in dividends and executed $16 million in share repurchases. That's a total of $36 million in shareholder returns. This sends a really strong signal of confidence from management about their liquidity and their long-term strategy.
So the crucial point is how management views the road ahead. Girish Saligram was very clear on this. A return to the pre-conflict operating levels is expected to be gradual, contingent on continued regional stability. They've slightly reduced their full-year outlook to reflect this reality, but they still expect a significant ramp-up in margin contribution in the second half of the year. It's basically a stance of cautious, grounded optimism.
Which leaves us with a fascinating question to wrap up on. How will ongoing Middle East volatility reshape the global energy services landscape? Weatherford's Q2 shows us that modern energy companies have to be built to absorb geopolitical shocks while simultaneously innovating for the future. But as this volatility continues, will we see a faster pivot to alternative markets, or maybe deeper industry consolidation? It's a delicate, fascinating balance, and one we are definitely going to continue to watch closely. Thanks for joining me on this explainer, and we'll catch you next time.